Welcome to the Trending Report, brought to you by USA Financial. The Trending Report is a series that aims to focus on the trend lines rather than just the headlines. Each episode features commentary around the state of the market, as well as other factors that may impact your personal finances. The host of the Trending Report is an investment advisor representative of and securities are offered through USA Financial Securities, member FINRA SIPC, a registered investment advisor. The Trending Report is educational and not intended as personal financial advice.
Welcome back to the Trending Report. Q1 of 2026 was a wild ride. We had record highs, a geopolitical shock, and one of the biggest oil price spikes in our near history. But here's our North Star. Trend lines beat headlines. Instead of reacting to the noise, we're going to take a look at what the data is actually telling us. So let's get into it. Let's set the stage. US stocks started the year near all-time highs, and then we hit a wall. Geopolitical tensions rattled investors, and tech stocks took it the hardest. But here's what surprised a lot of people. International and emerging market stocks actually held up better than the US market. Volatility, it definitely spiked hard. And the big driver there was Brent crude oil. Brent crude oil jumped 63% in March alone. And that's the single largest monthly oil price increase in 4 decades. That oil shock flipped the script on which sectors were winning. Energy stocks surged right alongside the crude prices and became the clear leader of the quarter. Tech, which had dominated for years, has stalled out. And honestly, that wasn't really much of a surprise. Valuation has gotten stretched out, and investors started looking towards safer ground. The value stocks. So think of stable, fairly priced companies. They beat growth stocks by nearly 10 percentage points this quarter. And for the first time in a while, smaller caps are actually outperforming the larger caps. While the US market struggled, the rest of the world had a different quarter. Japan's stock market rose single digits, powered by a weaker yen and a decisive election result that pointed towards more economic stimulus. Emerging markets were the real standout, thanks to cheaper valuations and stronger earnings. Europe dipped a little as rising gas prices raised some concerns, although nowhere near the crisis levels of 2022. The bottom line, diversifying beyond US stocks paid off in Q1. Analysts see double-digit profit growth across major global markets in Q2 and through 2026. Commodities absolutely stole the show this quarter. The Bloomberg Commodity Index, which tracks everything from oil to grains to metals, surged, making it the top performing asset class of Q1. Rising energy prices rippled through the global supply chain, pushing grain prices higher too. Gold did exactly what it was supposed to do in uncertain times. It climbed, acting as a hedge against inflation while interest rates stayed suppressed. And if you had commodities in your portfolio this quarter, you definitely felt it. So what actually caused all this? Market analysts were already bracing for a rough first half of 2026, even before any geopolitical news. History shows that midterm election years tend to see meaningful pullbacks, averaging around an 18% from market highs. Markets just needed a trigger, and that trigger was Operation Epic Fury. US and Israeli military strikes in late February that escalated into a prolonged conflict, damaged major energy infrastructure, and effectively shut down the Strait of Hormuz. That closure is what sent oil prices through the roof. Now, here's the good news. Underneath all the turbulence, one of the most powerful investment cycles in modern history is still running full speed. Global AI spending hit $400 billion in 2025 and is expected to reach $600 billion in 2026. To put that into perspective, this investment wave is already larger than the telecom boom in the 1990s, and it could grow to represent 4 to 5% of the entire US economy. Last year alone, AI-related spending accounted for 1% of all U.S. economic growth. And the U.S. is dominating. U.S. private AI investments was nearly 12 times higher than China's in 2024. The payoff? Well, the S&P 500 earnings are predicted to grow double digits this year. So what does that mean for your portfolio right now? There's a Bloomberg model that tracks 170 ETFs across stocks, bonds, commodities, and alternative assets. Currently, it's showing about 42% of those assets are showing what they call a potential buy signal. Historically, when we're at this level, it means that markets may need to drop a bit more before the real buying opportunities emerge. Holding some cash right now puts you in a defensive position, ready to buy that dip. We did see a small rally at the end of the quarter, but I wouldn't read much into it. That looked like traders closing out positions and not a genuine market reversal. To wrap it up, 3 things to take away from Q1. First, diversify globally. International markets outperforming US markets this quarter is a perfect reminder that putting all of your eggs into one basket can cost you. Second, take the emotion out of it. Markets go up, markets go down. A rules-based, formulaic approach keeps you making smart decisions even when the headlines feel scary. And third, stay the course. Corrections of 10 to 15% are completely normal in a healthy bull market, and they're not a reason to panic. They're where opportunities are created for disciplined investors. Thanks for tuning in to the Trending Report. Stay informed, stay disciplined. I'll see you next time.
Thanks again for listening to this episode of The Trending Report, powered by USA Financial. We invite you to visit usafinancial.com to find out more about our work with independent advisors and their clients all around the country. Any projections, targets, or estimates in this report are forward-looking statements and are based on the firm's research, analysis, and assumptions. Due to the rapidly changing market conditions and the complexity of investment decisions, supplemental information and other sources may be required to make informed investment decisions. All expressions of opinions are subject to change without notice. Clients should seek financial advice regarding the appropriateness of investing in any security or investment strategy discussed.